Welcome back. Artificial intelligence taking all major industries by storm. Generative AI producing authentic text, images, audio, and synthetic data. A new KPMG survey finds 58% of customers and consumers say generative AI has a significant impact on their current professional lives. 77% said that it will have a significant impact within 2 years. Consumers also trusting the use of generative AI across various platforms, including education resource, personalized recommendations, customer business, customer service, and in business. Joining me right now is the chairman and CEO of KPMG, Paul Knopp. Paul, great to have you. Thanks very much for being here.
Maria.
So I want to get into AI, but I also want to get your take on what your clients are doing right now in terms of allocating capital and how they see the year ahead. Give us your thoughts on the impact of AI. Did you just hear Kristalina from the IMF? She called out lawyers, accountants, high-end, high-paying jobs will go away because of AI.
Well, I think in the long term, there will be job disruption, Maria, no doubt about it. You know, that survey you cited where 76% of millennials and Gen Z said their jobs are already significantly impacted by generative AI, and there has not been significant job loss to date. So what I think that means is that we are putting it into the mainstream now, and the workforce is still very flexible today. We also know that we have structural imbalances in the workforce still, in the labor market, I should say. So I'm optimistic that the economy is going to be able to absorb what might be a bit of a shock of the disruption of this technology over time.
We were all worried about all the, new entrants within tech, right? Every time we get something new, people worry about the impact on jobs.
That's a great point. So you think about all the different emerging technologies we've put in place over the last 25 years. Right. And yet there's been net job growth and not net job loss.
Okay.
And I think that with every emerging technology, we have seen that over time. And maybe the nature of some of what people do changes. And that same study said that these individuals that took the survey, that they weren't that worried about job disruption. They thought that their mental health would actually improve, meaning that more mundane tasks might be automated, allowing them to do more valuable things in their work.
Let me switch gears and ask you about your own business. You've got a specialty in terms of advisory, in terms of tax advice as well. Corporate and private equity M&A firms showing optimism for deal making in 2024. And I want to get your take on whether or not the log jam is breaking. We've had a real drought in new deals, but your new KPMG survey finds 2/3 of executives are expecting more deal making this year. Tell us what you're seeing.
So first of all, 2023 was a very low bar for deal making. So
and 22 as well, right?
And 22 as well to some degree. And we're hoping for more activity this year. I think the executives that we surveyed are more confident about 2024. I think there's a couple of reasons for that, Maria. Number one, we're getting a lot more clarity about future interest rate policy. And to the corporate sector, interest rate sensitivity on M&A is not as important as to private equity. It's pretty important to private equity. Probably the more interesting problem is valuation still. So we're still seeing a lack of meeting of the minds between buyers and sellers on what proper multiples and valuations should be. So therefore, that's a real impediment to deal making. We expect that hopefully will start to subside in the later half of the year.
Yeah, but I mean, if higher interest rates are a factor, doesn't that pressure deals done with debt, for example? I mean, how does the Fed fit in?
And no doubt about it. So everybody's going to be watching very closely the Fed in terms of future rate cuts. And as I mentioned earlier, private equity seems to be leaning into doing more deals if rate cuts happened. So we'll be watching for that. And I think that there's no doubt that there's a ton of cash at corporations and private equity, dry powder as we call it, waiting on the sidelines, waiting to be spent, and they're still raising funds. So there's no doubt there's a force there that could cause more deal making later in the year. And we'll have to all adapt to that higher rate environment while knowing that rates might be a little bit lower at the second half of the year.
Are they going to need some of those cash for higher taxes? What's your expectation in terms of tax policy for corporates this year?
Yep. We don't see any real change in tax legislation this year. Of course, the personal tax rates expire at the end of next year, 2025. But for corporations, they're not dramatically affected by those expirations in 2025. But yet, that can still affect the economy when you think about tax impacts on people and consumers.
Yeah. Paul, it's great to get your insights. Thank you.
Yeah, great to be here. Thank you for having me.
Thank you so much.